not the problem. Bad debt is the problem. Rich people understand one simple rule. Money has a cost, but money can also produce a return. Imagine you borrow $100,000 and the bank charges 5% interest. Most people stop thinking there. They only see the cost. But rich people ask a different question. What can this money earn? If that borrowed money earns 10% while the loan only costs 5%, they keep the difference. That difference is called the spread, and the spread is where wealth is created. Debt becomes powerful when the return is greater than the cost. Now imagine real estate. A house costs $500,000. An investor only puts $100,000 down and borrows the rest. The investor now controls a $500,000 asset using only a fraction of their own money. If the property value rises 10%, that is $50,000 gained. But remember, the investor only invested $100,000. That means their return is much larger than if they bought the property fully in cash. This is called leverage. Leverage magnifies outcomes. It can grow wealth faster, but it can also increase risk. Smart investors understand this and never ignore the downside. Rich people do not borrow to buy things that lose value. They borrow to control assets that can produce income or grow over time. This is why businesses borrow money to expand. This is why investors borrow to acquire assets. They are trying to create positive spread. There is another strategy wealthy people use. Instead of selling assets and paying taxes, they borrow against those assets. Imagine owning stocks that keep increasing in value. Selling creates taxes. Borrowing creates liquidity without selling. Their investments continue growing while they use borrowed money for spending. That strategy only works because their assets continue producing value over time. But there is a danger. Leverage works in both directions. If the asset falls and the debt remains, losses can grow quickly. That is why poor debt decisions destroy people. Credit card debt at high interest rates is one of the biggest examples. Borrowing at 24% to buy things that lose value is negative spread. That is not investing. That is paying rent on money that creates nothing. Wealthy people focus on reducing the cost of money. One of the biggest tools for that is credit score. Better credit means lower rates. Lower rates improve spread. Improving your credit score can save tens of thousands of dollars over your lifetime. The rich do not have secret banks. They simply qualify for cheaper money. That changes everything. So ask yourself one question every time you borrow. Will this money earn more than it costs? If the answer is yes, debt can become a tool. If the answer is no, debt becomes a trap. That is the difference. The poor ask how quickly they can pay debt off. The rich ask how efficiently debt can work for them. Same loans, same interest rates, different decisions. Debt is just rented money. The only question that matters is whether what you do with that money earns more than the rent. Once you understand that, you stop fearing debt and start understanding it. Subscribe for more finance lessons that schools never teach.
Coming into the mall with hopeful eyes. A world of potential awaited him, or so he thought. As he wandered through the aisles, something caught his eye. A shiny credit card floated toward him, glowing like a treasure from a fairy tale. His heart raced as he reached out to grab it, the thrill of instant access to money coursing through his veins. But just as his fingers brushed the card's surface, a sudden chill swept over him, and the scene froze. Before you touch that card, let me show you what's actually about to happen to you, a narrator's voice echoed, pulling Alex into a whirlwind of visualization. The vibrant colors of the mall faded, replaced by a chaotic storm of floating red numbers, ominous bills, and an overwhelming sense of dread. Stress surged through him like wildfire. His hair felt as if it were ablaze. The narrator continued, weaving a tale about credit cards that sounded tantalizing yet treacherous. Credit cards. They give you free money. They give you rewards. They call it a benefit. And 189 million Americans have at least one. Alex felt the weight of his aspirations crashing down as the truth unfolded. Suddenly, a bank rep appeared, grinning widely while handing Alex that same shiny card. As Alex accepted it, fine print exploded everywhere, swirling around him like the confetti of a deceptive celebration. The narrator's voice, now steady and serious, explained, "Okay, first, what even is a credit card? Simple. The bank gives you a spending limit, let's say $5,000. You spend it, then you pay it back. Sounds innocent, right? Each month, a bill would arrive, laying out a stark reality. Total amount due, $1,200. And beneath it, the tempting minimum payment, $35. Alex could almost feel the relief of that low number, but it was a trap, designed to lull him into complacency. The narrative revealed the sinister mathematics of debt, where the remaining balance grew, multiplying like a voracious beast. As the numbers danced around him, they transformed into a mountain of debt towering over him, casting a shadow of despair. The average credit card APR in America is 21%, the narrator declared, the words sinking into him like stones. The reality was stark. If he only paid the minimum, he wouldn't just owe money, he would pay nearly double what he borrowed. His money, once a hopeful investment in his future, now floated away, disappearing into the lavish lifestyle of the bankrupt's mansion. This is the minimum payment trap, the narrator warned. The banks aren't evil, they're just very, very good at math. And they're betting you're not. The weight of ignorance pressed heavily on Alex's shoulders, and he felt a surge of desperation. Then came the bright lights of rewards. But wait, what about the rewards, the cashback, the miles? Those are real, right? The narrator offered a glimpse of hope, but it was quickly overshadowed by reality. Studies revealed that people spent more when using credit cards, losing sight of their finances. Alex watched as he paid with cash, each bill tugging at his heart, while swiping his card brought a fleeting sense of joy, only to lead him deeper into financial quicksand. As the visuals shifted, a giant number, 720, floated in the sky, revered by all. You need a credit card to build credit, the narrator affirmed, breaking down the components of the credit score that dictated the course of Alex's financial life. Yet the shadow of the private companies controlling the score loomed ominously over him. He felt like a puppet, strings pulled by unseen forces, but amid the gloom, a glimmer of hope emerged. The narrator introduced Smart Alex, who stood confidently, ready to reveal the rules of using credit wisely. Never carry a balance, keep utilization under 30%, and treat credit like a debit card. Each tip was a beacon of clarity in the murky waters of credit. The story split into two paths, one where Alex succumbed to the trap, and another where he embraced knowledge. He envisioned himself in 5 years, one path leading to despair, drowning in debt and anxiety, while the other blossomed with financial freedom, savings, and peace of mind. The stark contrast painted a picture of a future only he could shape. The scene shifted back to Alex, who faced the camera with a newfound determination. Credit cards aren't the villain, ignorance is. Now you know the trap. Now you know the rules. One decision this week, check your credit card statement. Find your APR. See what you're actually paying. Knowledge is the first move. Everything else follows. As the screen faded, the narrator invited viewers to join him in the next exploration, promising to unveil the truth about student loans that would stir anger and awaken awareness. The upbeat outro music played, but Alex had already transformed. A young man now armed with knowledge, ready to conquer his financial future.
It's a random Sunday afternoon. You're scrolling through YouTube or Instagram, and you see one of those videos, How I Became a Millionaire in 18 Months. Or turn $1,000 into $1 million with this simple trick. And for a second, you think, wait, am I missing something? Because you work hard. You make a decent income. But when you open your bank account, it definitely doesn't look like millionaire progress. So naturally, you start wondering, is building wealth actually possible? Or is everyone online just exaggerating? Look, here's the thing. A lot of financial advice online falls into two extremes. On one side, you have the get-rich-quick crowd, crypto secrets, day trading systems, dropshipping hacks, and on the other side, you have the super slow advice. Just invest for 40 years, and maybe you'll be comfortable when you're 65. Neither of those answers are very satisfying. But here's what most people don't realize. Building real wealth doesn't take 40 years, and it definitely doesn't happen in 6 months. But 5 years? 5 years is actually enough time to completely change your financial life if you focus on the right things. And in this video, I'm going to show you the realistic path to building serious financial momentum in the next 5 years. Not the flashy version, the version that actually works. My name is Jack, and I spend way too much time thinking about building my wealth. If you're someone who struggles to build wealth, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Okay, let's start with the first uncomfortable truth. Wealth is not built through saving alone. Now, you might be thinking, wait, isn't saving money the entire point? Well, yes and no. Saving money is important, but saving alone is like trying to fill a swimming pool using a teaspoon. Here's what I mean. Let's say someone saves $300 per month. That's actually better than most people. According to data from the Federal Reserve, nearly 40% of Americans can't cover a $400 emergency without borrowing money. So saving $300 per month is solid. But let's look at the math. $300 per month equals $3,600 per year. Over 5 years, that's $18,000. Even if you invested that money and earned around 8% annually, you'd end up with roughly $21,000 to $22,000. That's good, but it's not life-changing. And this is where it gets really interesting. Because the biggest driver of wealth in the first 5 years is not investing. It's income growth. Here's what most people don't realize. Early in your financial journey, your most powerful asset isn't your savings account. It's your earning ability. Think of your income like the engine of a car. If your engine is small, no amount of clever steering will make the car go fast. You need more horsepower. And the same is true with money. If you increase your income, everything else becomes easier. Saving becomes easier. Investing becomes easier. That disappears faster. Let's look at a simple example. Imagine two people. Person A earns $3,000 per month and saves 10%. That's $300 per month. Person B spends the first 2 years improving their skills, negotiating raises, or building side income. Their income increases to $5,000 per month. Now they save the same years. And if the gap grows even larger, the difference becomes massive, which leads to the first step in building wealth in 5 years. Step 1, increase your income. Now before you roll your eyes and think, Jack, if it were that easy, everyone would do it. Look, I get it. Income growth doesn't happen overnight. But most people underestimate how much their income can grow in 5 years. 5 years is enough time to learn a valuable skill, change careers, start a side business, negotiate multiple raises. In fact, data from the U.S. Bureau of Labor Statistics shows that workers who switch jobs often increase their salary 10 to 20% on average. Do that twice in 5 years, and your income could look completely different. But income alone isn't enough. Because here's the second trap people fall into. Lifestyle inflation. You get a raise, and suddenly you upgrade everything. Better apartments, better car, more expensive habits. Before long, your income increases, but your bank account stays exactly the same. This is one of the biggest wealth killers. And psychologists actually have a term for this. Hedonic adaptation. Your brain quickly gets used to improvements in lifestyle. That new car feels amazing for about 3 months. Then it becomes normal. And suddenly you want the next upgrade. Which is why step 2 is crucial. Step 2. Lock in your savings rate. Here's a simple rule that works incredibly well. Every time your income increases, save at least half of the raise. So if your income increases by $1,000 per month, you automatically invest $500 of it. The other $500 you're free to enjoy. This prevents lifestyle inflation from stealing your progress. Now this is where the investing part finally comes in. Because step 3 is about making your money work. Once you have consistent savings, those dollars need a job. And historically, one of the most reliable tools for long-term wealth has been broad market investing. For example, the S&P 500 has returned roughly 10% annually on average over the last century. Of course, markets fluctuate in the short term, but over longer periods, consistent investing has been one of the most effective wealth-building strategies available. Let's do a quick 5-year example. Suppose after increasing your income and controlling lifestyle inflation, you invest $1,000 per 5 years, that's $60,000 invested. With moderate market growth, that can become around $70,000 or more. Now, here's what most people don't realize. The real magic isn't the 5 years. It's the momentum you build during those 5 years. Because once you reach that level of investing, the next 5 years accelerate dramatically. Let me tell you a quick story. A friend of mine spent his early 20s constantly stressing about money. His savings were tiny. His income nearly covered expenses. But he made one decision. For 5 years, he focused on 3 things only: increasing income, avoiding lifestyle inflation, and investing consistently. Nothing flashy, no risky trades, just discipline. 5 years later, he had over $80,000 invested. More importantly, his income had doubled, which meant the next 5 years were going to move even faster. That's how wealth actually builds, not overnight, but through compounding momentum. So, if you want to build wealth in the next 5 years, here's the realistic roadmap. First, focus on increasing your income. Your earning ability is your most powerful financial asset. Second, protect yourself from lifestyle inflation. Save at least half of every raise. Third, invest consistently in long-term assets that grow over time. And fourth, stay consistent for the full 5 years. Because here's the truth most people don't like hearing. Wealth doesn't come from one brilliant decision. It comes from hundreds of small decisions repeated consistently. And look, 5 years from now is going to arrive whether you prepare for it or not. The only question is what your financial life will look like when it gets here. Will you still feel stuck? Or will you have built the kind of momentum that makes the next decade completely different? Because sometimes the difference between staying broke and building wealth is simply choosing a better strategy and giving it enough time to work. If this video helped you think about money a little differently, hit the subscribe button. And I'm curious about something. Where do you want your finances to be 5 years from today? Let me know in the comments. Because that future starts with the decisions you make this year. Picture this. You finally do the responsible thing. You start saving money. Every month you move a little bit into your savings account. $100 here, $200 there. You feel good about it. Responsible, disciplined, financially mature. But then one day you open your banking app and realize something strange. Your savings account has $10,000 sitting there, and it's earning something like 0.5% interest, which means after an entire year, you've made $50. Meanwhile, you keep hearing people talk about investing, stocks, index funds, compound growth, and suddenly you start wondering, wait, am I doing this wrong? Because saving money is good, but saving alone really builds real wealth. And this is where a lot of people get stuck. They know saving is important, but they have no idea how to transition from saving to investing. So in this video, we're going to break down the exact step-by-step path to turn saving into investing without feeling overwhelmed or risking your financial security. My name is Jack. If you're someone who has money sitting in savings but isn't sure how to start investing it, make sure to hit the subscribe button and give this video a thumbs up. Let's start with something that might sound controversial. Saving money alone will almost never make you wealthy. Look, saving is important, but it's not the final goal. It's just the first stage. Because here's the thing. Savings protect your money. Investments grow your money. And those are two very different jobs. Let's look at the math for a second. Imagine you save $10,000 in a typical savings account, earning 1% interest. After 1 year, you have $10,100. Not bad. But now let's compare that with investing. Historically, the S&P 500 stock market has returned about 10% per year on average over long periods. If that same $10,000 earned 10% annually, after 1 year you'd have $11,000. Now that difference might not seem huge at first, but here's what most people don't realize. The real magic is compounding over time. After 20 years, savings at 1% equals about $12,200. Investing at 10% equals about $67,000. Same starting money, completely different outcome. And this is where it gets really interesting. The biggest wealth gap isn't usually between people who save and people who spend. It's between people who save and people who invest. But here's the problem. Most never make that transition. And the reason isn't that. It's psychology. Saving feels safe. Investing feels risky. When your money sits in a savings account, you can see it. It doesn't fluctuate. It doesn't drop 5% on a random Tuesday afternoon. But investments, they move. Sometimes up, sometimes down. And that emotional volatility scares people away. Now you might be thinking, okay, Jack, but I don't want to lose my savings. Totally fair. And that's exactly why the transition from saving to investing should happen in stages. Not all at once. Let's walk through the step-by-step path. Step 1. Build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This money stays in savings. It's not for investing. It's not for opportunities. It's for unexpected problems. Job loss, medical emergencies, car repairs. Because here's what most people don't realize. The biggest reason people panic sell investments is because they need the money too soon. An emergency fund protects your investments from your own life. Step 2. Separate saving from investing mentally. This is huge. Think of saving and investing as 2 different buckets. Bucket 1, safety money. Bucket 2, growth money. Safety money doesn't move. Growth money is allowed to fluctuate because its job is to grow over time. This mental separation reduces anxiety dramatically. Step 3. Start investing small. Look, a lot of beginners think investing requires thousands of dollars. It doesn't. Many brokerage platforms allow you to start with $50 or $100. The goal isn't massive profits at first. The goal is building the habit, because habits matter more than time. Step 4. Focus on simple investments first. Here's where beginners often make a mistake. They jump straight into complicated strategies. Day trading, options trading, crypto speculation. But the simplest investments often outperform complicated ones. For example, index funds. These funds track the overall stock market. Instead of trying to pick winning companies, you're investing in hundreds of companies at once. Diversification, lower risk, long-term growth. It's simple and it works. In fact, legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most investors. Now here's what most people don't realize. The most powerful investing strategy is actually pretty boring. It's called consistent investing. Let's look at a quick example. Imagine you invest $300 per month into the stock market. If the market averages 8% per year, after 25 years, you have roughly $285,000. But here's the crazy part. You've only contributed $90,000. The rest, almost $195,000, comes from investment growth. That's compounding working in your favor. But psychology still matters here, because investing feels uncomfortable at first. Markets go down. News headlines get dramatic. People panic. And this is where discipline separates investors from gamblers. Let me give you a quick analogy. Saving money is like storing seeds in a jar. You're protecting them, but nothing grows. Investing is like planting those seeds in the soil. At first, it looks messy. You don't see results immediately. But over time, things grow. And eventually, you have something far bigger than the original seeds. Now you might be thinking, okay, but what if I start investing and the market crashes? Great question. Because market crashes are normal. It happens dozens of times in history. But here's the key insight. Long-term investors actually benefit from downturns. Because when markets drop, your monthly investments buy more shares at lower prices, which often leads to stronger returns when markets recover. This is why many experienced investors stay calm during market volatility. They're thinking in decades, not days. So let's summarize the step-by-step path. First, build a 3 to 6 month emergency fund. Second, separate your money into safety money and growth money. Third, start investing small amounts consistently. Fourth, focus on simple long-term investments like index funds. And fifth, stay disciplined and give compounding time to work. Because here's the truth most people eventually learn. Saving money gives you stability, but investing gives you freedom. The earlier you combine both, the more powerful your financial future becomes. If this video helped you understand the path from saving to investing, make sure to hit subscribe. And I'm curious about something. Are you currently in the saving stage? Or have you already started investing? Let me know in the comments. Because the moment you transition from saving to investing, am I still not getting ahead financially? The answer surprises most people. It's not always because they don't work for it. It's because most people are taught to trade time for money. And time is limited. Think about it. There are only 24 hours in a day. If your income depends only on the hours you work, eventually you hit a ceiling. But the people who just work for money, they build systems